So welcome back. Now, in this episode, I'm answering your question, where to invest with low risk. And boy, there's lots of places to do it. For sure, you're going to find a lot of different opinions. There's nothing wrong with banks, nothing wrong with the federal government. They're all going to be glad to accept your deposit, and they'll hold your money safely and securely, basically with no risk. Now, the federal government sells savings bonds and treasury notes. So this is another source where you can invest in very low risk, and your principal isn't going to be at risk at any time. The challenge is the interest rates are so low. So these accounts are special accounts. Now, some people go to the stock market and they like to have money market accounts. Well, there's lots of accounts, but the challenge is they're going to have such low interest rates. So your money's safe and secure, but what happens if you have some inflation? And that's what the problem is with money today. So yes, you've got low risk and you've got security for your money. The challenge is going to be the exposure you have to inflation. Now, the federal government prints money on a regular basis. Now, what do they do with that money? Well, they make a lot of social programs, okay? Now, if they have those social programs, every time they print money, that's going to upset the market. I mean, the stock market and the investment markets get upset when the government inflates the money. So I'll be right back and tell you more about that. All right, now, what are we talking about today? Where to invest in low risk. So in today's episode, that's the question I'm answering, low risk. Now, that low risk is easy to find. So there's plenty of safety in putting your money in a local bank, plenty of low risk when you're putting money in government certificates. So you're not going to have to worry there. Your challenge is going to be, what's going to happen to the money? Is it growing or is it just depreciating? And that's a big run. So you're going to have this challenge for the rest of your life. So you got to give that some thought. So if there's low inflation, like 1%, and you're at least making 1%, you're staying even. But what if you have 5 or 6%, which I'll talk about? So the markets are constantly moving up and down, up and down. So if you follow the markets, you'll see that. Now, it doesn't matter whether it's the commodities market or whether it's the stock market or the Bitcoin, the market's floating. It's always going up and down. And it's going up and down for a reason. There's always a reason that the market is affected. Now, it's affected a lot by the leadership of the government. Now, if the government, whatever they are doing or they're not doing, is going to affect the marketplace. So if they're inflating the money and they're creating social programs, expect that that's going to create inflation, and that could depress the market. The market doesn't like it at all when there's inflation going on. Why? Because they know people with savings accounts are losing their money, and they don't want that to happen. All right, so if we have a free spending government that's constantly creating social programs, that means that the bureaucrats are getting more votes because they want a lot of social programs, because the socialists are happy. But what happens to the money market? The money market's going to be depressed. And what's going to happen to money in the bank? Well, that's the big challenge. Yes, you've got lots of low risk. Well, you really like that. And you have security. However, is your money doing okay? Is your money still valuable, or is it losing value? All right, so anytime the money's eroding with inflation, what's going to happen? Well, that's going to cause you to start to think, wait a minute, when am I going to run out of money? They're just going to keep inflating. So I'm going to kind of oversimplify with a $10,000 deposit in a savings account. Well, today, that savings account is probably going to pay less than 1%. Now, that's not very much money, but 1%. All right, so what if the government tells us they have 6% inflation? So you earned 1%, but problem is they inflated the money by 6%. So you ended up, instead of having the purchasing power of 10,100, you've got the purchasing power of probably 9,500. Well, what if that happens 3 or 4 years in a row? Suddenly you're down to, you only have the purchasing power of, say, $8,000. All right, so anytime the government's inflating, your money is at risk. Why is it at risk? Because it has less and less purchasing power. Now, I don't know that I can keep track of inflation, but it's a big, big problem. But the government can print money whenever they want to and just try to stop it. It's not going to happen. They're just going to keep doing that. They're going to keep doing that. Now, I'm exaggerating to a certain extent, but basically interest rates are 1% or less. Inflation's 5 or 6% right now, but inflation's going which way? It's going up. It always goes up. But if it does go up, what's happening to your treasury notes and what have you? All right, now should you worry about that? Well, you should. Now let me give you an example. Most people watching this are too young to realize this happened. But 100 years ago, in the 30s, the 1930s, the country that was central to the European continent was Germany. Germany's a big country. It's a big economic country. And they inflated their money. Now, what did they do with their money? They made social programs so they could get votes, and they built up a big military. All right. Now, as they did that, they kept inflating. They inflated so bad that when a woman would head off to the grocery store, the German mark, which we say the American dollar, the German mark, which was their currency, the woman had to go to the grocery store with a bag full of marks. In other words, she wanted to get a bag of groceries, but she needed a bag full of marks to give to the butcher and to give to the baker in order to survive. All right, that kind of inflation, you can imagine what was happening if you had to buy a car or you're trying to buy a real estate property or whatever. The point is, inflation can get that carried away. And it does, and if people aren't careful, they'll have plenty of social programs, but you won't be able to buy anything, and there won't be anything on the shelves. So anytime you see the shelves don't have things on the shelves, it's because people are inflating. All right, when the government inflates, you'll start to see the shelves in the stores. They can't fill them. Why? Because of the money situation. All right, is there a solution? I don't know that you and I are going to change the government. We can try to vote and change. However, when they print money, a lot of people like that, especially if they're not working very hard. They like getting checks from the government. They're all happy about that until all that money circulates, and then their purchasing power is way down. All right, so what happened? Well, it makes the economy go upside down. So about 30 years ago, I discovered a program. There was a government program that had been around for 200 years, and it was a way to make more money. So I'm going to suggest that you pay attention to inflation, but you're going to have to do something about safety and security in the future. It's not going to come from putting money in a bank. Why? Because it's depreciating all the time. All right, now this investment requires you to think about it. You're going to have to make some adjustments. You're going to make some small investments. It's an alternative investment, but it's been around for a couple of hundred years. Now, does this mean you're going to have to do some work or do something? Yes, you are. All right, it's going to be white collar work where you don't have to work hard. You don't have to go out and do fixer-uppers, but it's going to be a real estate business. And when I realized and found out that I could buy properties from the local governments, I said, what is this all about? Well, it turns out many people don't pay their tax. And when they don't pay their tax, the state legislature takes action. Now, they do that through the county treasurer and the county tax collector. And so someone that doesn't pay their taxes, the county treasurer, tax collector, will actually confiscate their property. The county doesn't want that property, but they confiscate it and then they resell it at auction. Now, when they resell that property at auction, what are they doing? What they're doing is they're taking a property that's on a defaulted list and they're going to try and put it back on the honorable taxpayer list. Okay, so they confiscate the property and then they resell it. Now, what do they resell it for? For market price? No. They sell it for 10, 20, or 30 cents on the dollar. Now, imagine you buying a property for 10 cents, 20 cents, or 30 cents on the dollar. When I discovered this business and saw I could buy for 20 cents on the dollar and I could sell at retail, there was a lot of margin there. And I wanted to make that margin. That meant if I could buy a property today, I knew exactly how much money I could make on it right away. I didn't have to wait for inflation. I didn't have to wait to improve the market. I knew right away. So when I discovered this program was affordable, that we could buy properties under 10,000 and over 10,000, I could buy almost any price I wanted. And there was 5,000 auctions every single year. So what did I do? I said, why don't I get involved in that business? Now, keep in mind, I didn't create the business. The state legislature authorized the counties to confiscate these properties that weren't paying taxes. Now, they didn't pay the tax. The local tax collector had a problem. They couldn't pay the police. They couldn't pay the fire department. They couldn't pay for the school teachers. So what they did is they confiscate the property. They sell it. Then they use the revenue. Are you getting the idea? All right. So that system worked. But you and I could buy at that auction for 10 or 20 cents on the dollar. Now, if I can buy for 20 cents and there's a market value for much more than that, why wouldn't I want to buy there? Especially when the treasurer X's out the mortgage. In other words, I buy a property that doesn't have a mortgage or a deed of trust loan on it. How good was that going to be? So it just kept getting better. So these confiscated properties, yes, They're slightly abused. Some of them are abused. Some of them haven't been taken care of. Some are abandoned. Some are ready to move into. I don't know which ones you're going to get, but I can tell you right now, these properties are coming up for auction by the thousands. There'll be over 1 million of those properties across the United States this year. So for 3 decades, I've taught my clients, buy these properties at these auctions. All right. So if you can buy a small property for $10,000 and sell it for $30,000 or $40,000, well, is that going to make up for a lot of that inflation? It sure is. So let me give you an example. So the tax assessed value is $90,000 for the property. It comes up for auction. The tax collector needs the money from that $90,000, okay? But they're not collecting it. So the person's $5,000 in default, so the auction starts at $5,000. Anybody can go in and pay the money and buy it. Well, what if someone goes in and pays 20 cents on the dollar? The property's worth $90,000. They pay 20 cents on the dollar. They pay $18,000 and they get it. The county gets the $18,000. They're happy, so the county's happy. Are you happy? Yes, you bought a property for 20 cents on the dollar. Well, now we're going to get that property back on the tax roll, so that's pretty good. All right, now the county's auctioning off the property. When they do that, they wipe out the mortgage. So now someone owns a property. What are they going to do with it? Well, I teach my clients, buy it low and sell it low. So my client is going to sell that property. And what are they going to sell it for? Well, they're not going to try and get $90,000. Just sell it for $55,000. Wait a minute, Ted. It's worth $90,000. Well, that's all right. I'm going to buy it low. I'm going to sell it low. I'm going to make the difference between the $18,000 I paid and the $55,000. Is that pretty good? Yeah, that's darn good. What if the buyer wants to have installments? In other words, they want you to give them a mortgage. I'll be happy to do that. So the selling price would be $55,000. Okay. The down payment, let's say you collect $10,000, and then I'm willing to take payments. Why not take payments for 10 years? Okay. 10 years of payments at $450 a month would be another $54,000. Now it's starting to sound like a lot of money and complicated. No, it's not complicated, but it's a lot of money because those people are going to pay you over that 10 years, $54,000, and your only investment was $18,000. All right, let's review. We bought a property that had a $90,000 value. We bought it for 20 cents on the dollar. That was $18,000. Now we sold it for $55,000, and then we collect monthly payments. So we get not only the down payment and monthly payments, we're going to end up with $64,000 total dollars on an $18,000 investment. I know you want to do a bundle of those. So go back through the math and look at those examples again. You could be doing the same thing. Now, before I go, if you're going to go to auctions, you need to pay close attention. Don't buy properties that you haven't seen. If you haven't had boots on the ground or someone that you know had boots on the ground, don't buy the property. Just like the woman, you wouldn't marry the man unless you'd seen him. Well, it's the same thing here. You want to make sure you see that property. You want to make sure it hasn't burned down. You want to make sure that it hasn't been a windstorm or been a hurricane. You want to make sure it's not next to a pig farm or something like that that smells. You're getting the idea. One other caution. When you're at the auction, don't try to win the auction. Try to get the best deal. If you're trying to win the auction, you're going to keep bidding too high. So the way you keep from bidding too high is always know your selling price before you do your bidding. For example, a $90,000 property, I know I could sell it quickly for $55,000, as I've done in this example. All right, if I know I can sell it for that, then I better buy it cheap. So that buyer knew they could sell for $55,000, so they only paid 20 cents on the dollar or $18,000. You could be doing the same thing. I'm Ted Thomas.